Well, thank you very much. Hello, everyone, and welcome to my presentation on the factors affecting the copper market in the last quarter of 2020 and the forecast for 2021. Firstly, let me introduce myself. My name is Tom Rutland, and I'm a commodity analyst at S&P Global Market Intelligence, and I primarily focus on the copper market, and I've been a commodity analyst covering the base metals for the last 8 years. So today, I'm going to start by briefly talking about exploration. Then I will move on to talk about our short-term outlook for the copper market, what we perceive to be currently driving the consumption and supply elements in the industry, what would be the driving factors in the market in the near term, and towards the end of my presentation, I will also talk about our long-term outlook. So as I said, I'm going to start off by briefly giving an update on exploration budgets. To give some context of what we do, every year we survey thousands of companies requesting their exploration budget by country, commodity, and stage of development for over 20 commodities, but notably excluding oil, coal, and iron ore. Those which opt not to participate are estimated with our estimates sent to the company for validation. In 2020, our survey covered over 2,500 companies, and the conclusion of our 2020 survey was that copper budgets were down by 24% as budgets were severely impacted by COVID-19. Latin America was the most impacted, and its portion of global copper budgets fell to 25% in 2020 from 28% in 2019, but it still holds the largest portion globally. Copper budgets were hit harder than the other commodities in 2020, but in 2021, we expect copper to regain those losses with good potential based on current prices to increase above 2019 levels. That said, gold will remain the primary metal for exploration thanks to its higher base starting point and strong prices, making exploration for gold very appealing. Our drilling charts look at reported drill hole exploration results. The data generated generally comes from junior miners that report their results to showcase their projects in hopes of getting more interest in their development, either from senior miners or to secure additional funding. Now, since this data set is focused on junior miners, there are countries such as Chile where the overall drilling activity may be underreported due to the fact that majors are such key players for their exploration and they don't report individual drill results. On the left-hand chart, you can see that drill hole announcements dropped off significantly in the second quarter and again in the third quarter. This was primarily a result of COVID-19. On the right-hand chart, you can see that the number of drilled copper projects recovered slowly during the September quarter. I would just quickly add that the data generated excludes auger drill results, since that type of drilling is very primitive and it also excludes bulk commodities. We exclude metallurgical and geotechnical drilling since they are technically non-explorative drilling, and there's a possibility that these types of programs are retesting already drilled holes. So moving on to the copper market fundamentals, before I talk about how we expect copper prices to perform in the near future, I will talk about how copper has performed so far this year. It has been very much a year of two halves, with copper prices dropping to a 40-month low in late March before bouncing back to around $6,900 per ton in October, the highest levels since June 2018. Prices bottomed out during the height of lockdown restrictions in China, but recovered ever since as its economy restarted and put stimulus measures in place. I will talk more about the full extent of the ramp up in Chinese consumption in more detail later on in my presentation. Due to the time of when these slides were made, the chart finishes on November 4th, the day after the US election, when prices were around $6,700 per ton, and it became apparent that Biden was going to win the US presidential election. However, prices have increased since, and I will talk more about why that is in more detail later on. So we assess there to be two main drivers in the copper prices increasing since March, the first being the weak dollar over this period. As you can see from this chart, there is a strong negative correlation between the copper price and the trade-weighted dollar. The dollar has been held down as the US Congress has been deadlocked over stimulus bills to spur the US economy because of US monetary policy, rate cuts, and because of concerns of the US virus toll. Going forward, Biden becoming US president will likely weigh down on the US currency further, as the former vice president is expected to bring in policies that investors view as dollar negative, including fiscal stimulus. Combined with optimism about Biden's green agenda and the latest vaccine developments, we believe this is why copper prices have increased over the week since the election. The main driver of prices increasing since March is the surge in demand from China after lockdown measures were eased. Some key economic data that highlights this resurgence in Chinese the China's economy is its Purchasing Managers Index and fixed asset investment data. As you can see from the chart on the left, China's Caixin and manufacturing PMIs have consistently stayed above the 50 level, which indicates expansionary territory every month since April. Meanwhile, there's also been a similar bounce back in Chinese fixed asset investment, where the year-on-year decreases have fallen every month since lockdown measures were relaxed in the country and have now moved into positive territory. Both of these indicators are strong signs for just how much the Chinese economy has been restarting, which is behind the massive increase in copper consumption over this period. There are also some key demand figures that directly show how much Chinese demand has ramped up over recent months. The two I've decided to show you today are Chinese refined imports and Chinese white goods production. On the left-hand chart, you can see that refined copper imports into China have increased by 45% during the first 8 months of the year compared to the same period of 2019. Meanwhile, on the right-hand chart, you can see white goods production. As you can see from this chart, output of refrigerators, washing machines, and air conditioners, all of which are copper intense, have been increasing substantially since March. So to put into perspective how much we assess that China is driving global copper consumption, here is a waterfall chart that shows how we expect global copper demand to change in 2020. Global copper consumption is expected to increase marginally this year. As you can see from this chart, China is the only region that is expected to increase consumption in 2020, more than offsetting decreases in every other region, which have been severely impacted by the pandemic and the measures imposed by governments to curb the spread of the virus. I'm now going to go through our copper price forecast for the next 4 quarters and the upside and downside risks to these forecasts. On the chart, you can see how we expect copper prices to perform compared to the consensus price forecasts from third-party analysts at banks and brokerages that we get access to through our subsidiary Capital IQ. We expect prices to average $6,755 per tonne in Q4, which means that we expect prices to increase marginally over the remaining weeks of 2020. This is partly on the confidence that we get a conclusive result of the presidential election, which in turn we expect to hold down the strength of the dollar and therefore copper prices up. But also mainly because we expect Chinese demand to remain strong for the remaining weeks in 2020. In the first quarter of 2021, prices are expected to fall slightly as Chinese demand is expected to start tailing off and mine production, resulting in refined production, starts to ramp up again as after disruptions due to the pandemic in 2020. Thereafter, in 2021, we expect lockdowns outside of China will start to ease, resulting in a ramp up of demand outside of China, which we expect to cause prices to rise. There are a number of upside and downside risks to our forecasts. On the upside, we could see higher than expected prices if China continues the relentless pace of copper demand growth that has been pushing up prices for the last 8 months. If Biden is able to resolve the trade conflict with China efficiently, again, this is likely to have a positive impact on copper prices. Copper prices would also be boosted if consumers turn to electric vehicles when car sales return as lockdown measures are eased globally. And finally, we could see an immediate increase in copper prices if we get a quick conclusion to the US presidential election, with President Trump conceding without causing too much disruption, with also a quick conclusion on the Senate front as well. On the downside, we could see prices decrease if no COVID-19 vaccine is developed within a year, or Pfizer's vaccine that we heard about earlier this week is not as effective as first thought or can't be distributed efficiently, and global lockdowns are continued in order to curb the spread of the virus. Again, a slow conclusion to the US presidential election will likely have a detrimental impact on copper prices. Meanwhile, Biden not implementing his green agenda or failing to ease trade tensions with China would also have a detrimental impact on copper prices. The most recent exchange data provides some support to our expectations that prices will rise over the remaining weeks of 2020. The chart on the left shows that exchange stocks have been falling over the most recent weeks, indicating that demand is picking up and the market is tightening, and supports price increases in the near future. Meanwhile, the chart on the right shows that open interest on the London Metal Exchange, which displays that the net long position of the traders has started to increase in recent weeks, again indicating that there is optimism in the market that prices will increase in the near future. So moving on to our longer term view, here you can see our forecast refined market balances and copper prices forecast out to 2024. As you can see from the chart, we expect the deficit in the market to increase over this period, which we expect to result in stocks in weeks of consumption falling to 9.6 weeks in 2024 from 11.5 weeks in 2020, which will lead to increase in copper prices. The refined copper market balance is expected to move from a 23,000 ton deficit in 2020, when prices are expected to average $6,066 per ton, to a deficit of 50,000 tons in 2021, when prices are forecast to average $6,315 per ton. We forecast that the deficit will gradually increase until 2024, when we expect the market to hit a 225,000 ton deficit and prices will rise to average $7,216 per ton. So I'm now going to go through our supply element of our forecast and explain why we believe supply will not be able to match consumption over the period to 2024. Starting with mine supply in 2020, there has been significant disruptions to output this year, primarily as a result of the pandemic. We estimate that Latin America has seen the biggest decrease in output in 2020 compared to 2019. However, as you can see from the chart, we still expect mine supply to increase in several regions, but we calculate that the decrease in China, Latin America, and Europe will more than offset increases elsewhere to cause global mine supply to fall this year. So looking further out, in 2021, we expect a 5.6% increase in mine output as production returns after disruptions this year. Thereafter, we expect mine supply growth to fall as assets move towards end-of-life production, head grades fall, while a lack of committed projects entering the project pipeline will mean that mine supply will not be able to meet demand for mined copper from 2023 onwards. Now, this analysis was completed in June, focusing on assets at a relatively advanced stage. Therefore, you'll note a project like Winu is not displayed in the chart, in part because the maiden resource announcement wasn't made until recently, and that no study has been released on its potential production profile. Given that our industry-wide analysis indicates that it can take 15 to 20 years to bring a new discovery online, bringing Winu into production by 2030 would be a relatively quick progression, but is not outside the realm of possibility for Rio Tinto. However, it is likely that our other projects will begin production in the second half of the decade should prices support relevant investments, efforts, and decisions. Here is a list of all the copper projects that we assess could feasibly come online before 2030. As it states that although committed projects will add 1.9 million tons of output annually, uncommitted projects could add a further 2.4 million tons a year. While there are some large committed projects, as you can see that the majority of the projects remain uncommitted, particularly those capable of producing more than 100,000 tons of mined copper a year. This again highlights that there needs to be significant investment in the project pipeline to meet mined copper demand in the longer term. As miners shift towards upstream investments, the industry requires participants to invest capital so that feasibility work can be completed and committed status can be achieved. Over the longer term, we expect increasing shortages of mined copper, which will only be alleviated with significant investment in new production. This is unlikely, however, given that most price assumptions for the projects remain above our copper price forecast for the period to 2022, making significant mined copper shortages in the medium to long term increasingly likely. So moving on to refined supply, and starting off by looking at 2020, there has been less significant disruptions caused by COVID-19 than compared to the mine supply side, but the majority of regions are expected to decrease output this year. China is the region that is decreasing output the most significantly, which partly explains the large increase in refined copper imports that I mentioned earlier. Elsewhere, we assess there to have been only minor disruptions to refined production as a result of the pandemic. Looking further out on the refined side, utilization rates are not expected to increase dramatically over the period of 2024. This is primarily due to the lack of concentrate availability over this period, which I mentioned earlier. Over the period of 2024, global utilization rates are expected to increase to just 80% from 77% in 2020, which we do not expect to be high enough to risk output in the future. Utilization rates are not expected to increase substantially, partly because global refinery capacity is expected to increase by almost 1 million tonnes per year by then. However, it is also because treatment charges are expected to fall from 2021 onwards. Firstly, next year, treatment charges are expected to rise again as concentrate availability increases with mine supply returning to the market. The concentrate market is forecast to be in 192,000 tonnes surplus in 2021, and TCs are expected to rise to $88 per tonne from $62 per tonne in 2020. However, from 2022 onwards, we expect treatment charges to fall as availability of concentrate becomes scarcer, which in turn will not incentivize smelter and refinery production to increase output substantially. By 2024, we expect the concentrate market to be in a 17,000 tonne deficit and TCs to fall to $57 per tonne. And so finally, here are our price forecasts for the period of 2024 compared to the consensus price forecast we obtained from Capital IQ. As you can see, we are very much in the middle of the range consistently over the period, but potentially on the slightly more bullish side. As I mentioned previously, there are plenty of downside and upside risks to our near-term and long-term forecasts, but generally, it is fair to say that there is definitely reasons to be optimistic on copper prices in the future. And with that, that concludes my presentation on the future of the copper market. I'm not sure we're going to have time for any questions, but if you do have any questions, I'm sure that myself or one of my team will be able to reply shortly afterwards. Thank you very much for listening.